blather.
Hello again. Great to see you. Thanks for joining me on the Constant Investors Facebook live stream. Boy, it was cold this morning in Melbourne. 4 degrees. Count them. 1, 2, 3, 4. It was very cold. So winter is upon us, which is fine. Love winter. And it's gorgeous days, really. Clear blue skies. Apparently it's raining like mad in Sydney, and I don't know what other places are doing, but it's good. And my elm tree is completely dumping all its leaves all over the backyard, which is always quite nice. Now we've been working on some suggestions from last week. We've been trying to entice Maxine Horn from Vita Group out of the bunker, where she's ensconced herself, negotiating with Telstra over their deal. As soon as she's available, we'll get her, I'm sure. Paul O'Malley from BlueScope was also suggested as an interview. We've got the bid in for him, and we're talking to AGL about getting CEO Andy Veazey from AGL, and so we're working on him. And also the other thing that was suggested last week, which is definitely happening, is that we're going to send Dave, our young reporter Dave Thornton, off to Kalgoorlie for the Diggers and Dealers Conference, and he's going to report back on that and take his recorder and record some interviews. So that'll be good. So thanks for those suggestions from last week, and any you might have today would be much appreciated. And please feel free to put some questions in as we're going along, if you have any, and any comments or suggestions for interviews. Love to hear them. I had Chris Richardson from Linneus in here yesterday. You might remember we interviewed Chris about 6 months ago. Now Linneus is a video technology business, which I think is very interesting and well worth looking at. The shares are only about 5 cents, and the company's just done a deal. The reason I got him back in was because they've just announced a deal with IBM, where IBM is going to sort of back them and sell the technology. So I thought that was pretty significant and worth talking to Chris again, which we've done, and we'll publish that on Monday. And we've done a bit this week for tonight's Talking Finance, looking at the national accounts, plus a few other things. We've got obviously the super rules are changing, and it's all about July 1st or June 30 this year. So we've done an interview with an expert on what you can do about what you should be doing about your super between now and June 30. And also spoken to a person from business in Austin, Texas in the US called Indeed, which is an American version of Seek jobs website, talking about how they're taking on Seek in Australia, and also being attacked themselves by Google Jobs, which announced 2 weeks ago that they're going to launch their own job search platform. So it's all happening in job search, and really if you're an investor in Seek or thinking about looking at Seek, then you really need to listen to this interview to understand what's going on in that space. Now remember, the live stream today, as always, is general advice and may not be appropriate for you. You should get your own advice if you have specific questions. And as I said before, if you've got any questions as we're going along, please feel free to put them in as we're going. First question now. Andrew says, "Hi Alan, could we be understating the potential future impact of any nominal price falls in property because we aren't factoring in the gearing equation and the cost of borrowing? For example, a recent purchase with a borrowing cost of say 5% per annum will suffer a loss not only on their equity capital but on the entire amount invested, notwithstanding massive ROE in property markets over the past 5 years." So a couple of differences with residential property in Australia, which I think need to be pointed out. Firstly, in the US, property investing, home mortgages are not they're non-recourse. That is to say, if you default on your home mortgage, it doesn't affect the rest of your life. The people just take possession of the house. And what was happening in the US, after the house price crash there, when prices fell by between 30 and 40%, is that people who went underwater on their home significantly, that is to say the equity on their home fell below the value of the mortgage, were sending keys back to the bank in envelopes. So I think it was called jingle mail because of the sound that the keys made in the envelopes. So there was a lot of that. People just walking out of the house, going and renting somewhere and letting the bank have the house. So there was a bit of that, but in Australia it doesn't work like that. If you default on your house, you're declared bankrupt and they take over everything, and it's a terrible event. So it tends not to happen. And the other thing is that with a lot of lending to buy assets, in particular say shares, where it's called margin lending, the bank tries to preserve the LVR, or the loan to value ratio. So if you borrow to buy shares, and you'll borrow say 50% of the value, the bank will preserve that 50% buffer. And so if the shares fell by 50% in value, or fell by anything really, the bank will do what's called a margin call, where you have to repay some of the debt in order to preserve the buffer, the LVR. That doesn't happen with residential real estate. So if the price of your property goes down, even if it goes below the value of the mortgage, the bank doesn't say, oh, well, you have to repay part of your mortgage now. So what tends to happen with price downturns in the Australian property market is that nothing happens really on the whole. People tend not to sell because they don't want to sell at lower values. The bank doesn't force them to sell. The only reason people sell, as a generalisation, is because they can't afford the repayments anymore, not because the price has fallen, which is what happened in the US. The prices fell, people sold their houses, the banks came in and sold their houses, which exacerbated the fall in prices. So, Andrew, I think that the impact of a nominal price fall within reason isn't going to be that great. It's really the combination of an increase in unemployment, or a big downturn in incomes caused by a recession, that will lead to big problems. What I'm saying, I guess, is that in this case, in the sort of the cause and effect issue of recession and property, I don't believe, and I might be wrong, but I don't believe that a downturn in property prices in Australia will cause a recession, but a recession will obviously definitely cause a downturn in property prices. And that's why downturns in property prices in Australia tend to be restricted to about 10%, which is what's happened in the past. We have big booms in property. We've had them in the past, as we've had now. This is obviously in Melbourne and Sydney in particular has been one of the biggest in history. And what tends to happen after these things is prices correct, fall by about 10%. But you don't get the snowballing collapse that occurred in the US, because where people are, banks are taking over houses and putting them on the market. Michael has just come in with a question. Hi Alan, I've got a tax question. I haven't seen this question at all, so we'll see. If you're in a pension mode and not yet in danger of the $1.6 million cap, is there any reason to even things up if your wife is 10 years younger than you, paying 15% on earnings in accumulation? Should we start the process when the timing becomes critical, or are we exposing ourselves to further legislative changes without enough notice? Yeah, look, I mean, obviously you're always exposed to legislative changes. I can't really advise you personally. I don't know what your circumstances are, Michael. In general, it certainly is a good idea to even things up if you can. I've got an interview with a financial advisor called Maria Dyson in the Talking Finance podcast tonight. You can either listen to the podcast, or you can have a look at the transcript of the interview, where she is talking about this sort of stuff. And it is, in general, a good idea to even things up if you can. And there are ways to do that. But you probably need some advice, personal advice on this, Michael, because it depends on, I think it'll obviously depend on exactly what's going on with your wife, and is she working? If you're in pension mode and she's not, look, you know, you need to, I'd say, get some advice of your own on that. I can't really help. Alan asks, hi, I have to reduce my wife's transition to retirement pension fund in the SMSF, 3 sub-accounts, as it is over the 1.6 million cap. I will work for at least the next 3 years and have a high income. I assume I should designate that the drawdown into the accumulation fund comes from one of the pension accounts which is taxable. Comments. Again, I can't give you personal advice. I'm just not licensed to do that, and you need to, I think you need to get personal advice here, Alan. In general, I'd say that drawdowns do come from, you do want obviously you want the drawdown from an accumulation fund that's being taxed to go into the untaxed 1.6 million retirement pension account. I mean, that's just obvious. You need to get the maximum into people need to get the maximum you can into the tax-free pension account up to 1.6 million. That's it. I mean, and you need to move anything you can, but you need to get some individual advice about how to do that, Alan. Better than I can provide now. David says, have the big banks reached value yet, and so should be bought if you don't have too much of them? Last night's interview with stockbroking analyst Andrew Tang from Morgans did talk about this a bit, David, and I think it's right that the banks are approaching decent value. You need to have a view that you're comfortable with investing in banks, given what's going on with fintech. But look, you know, there's a good reason to think that they'll be okay because of their oligopoly position, and they're also all investing quite a lot in fintech themselves. So there's no reason to think necessarily that they'll be disrupted to the point of you know, of getting into strife. So Andrew Tang had the interview with Andrew Tang, if you go to the website and have a look at it, was about his what he calls high conviction stocks. So he had I think 6 high conviction stocks, which he's saying provide the best returns over the next few years, and one of them, surprisingly, was Westpac. He's saying that all of the big banks represent good value. Of the 4 of them, Westpac is the best value. He's saying that simply because they have fallen to a price that represents good value, and they've got a fantastic yield, a grossed up 9% yield, and that plus the potential capital growth over the next year or two should provide something. I'm just trying to remember, I think it was 25 or so %, a total shareholder return that they're forecasting from Westpac. And so, yeah, if you're not too exposed to banks, I reckon they are decent value, good yielding stocks, and well-run companies in solid industries. Ted says, hi Alan, given there's an increasing noise about the weakness in the Australian economy, can you highlight sectors or companies that may perform better in this environment? As sad as it is, if interest rates rise, you'd have to think businesses operating in the credit impaired segment, for example, may actually grow. Well, that's certainly true, Ted. I think that you're onto something there. Interest rates may not move for a while though. As you say, the economy is pretty weak. Inflation is non-existent, virtually. So I think there's no chance of interest rates rising for about 12 months. But eventually they will rise, and at some point that's going to cause some difficulties because the amount of debt is so high and it won't be repaid by the time interest rates start going up. Absolutely, I do think that that's a good idea. That what you'd call the credit impaired segment of the economy. What does that mean? It means, I suppose, companies that benefit from that. I'm struggling to think of them, to be honest. Highlights segments or companies that may perform better in this environment. Look, Ted, what I wrote a couple of weeks ago was that given the sort of the weakness of the Australian economy and the problems that we're having here, that the best place to invest is somewhere else. So I've been highlighting Europe and India in particular. As to within Australia, look, I think I'll have to get. It's a bit hard to think on the run. I'll give it some thought, Ted, and write something in the overview about in answer to your question. So keep an eye out for that. How's that? Michael asks, "Hi, Alan. Nowhere near the 1.6 cap here, but if a fund grows to that figure and beyond, do you have to immediately transfer to an accumulation fund and pay the 15%? Well, you can only have up to 1.6 million in the tax-free pension account. I'm not actually sure what happens if you got more in that account, whether you just pay the 15% of the difference or you have to transfer money out. Maybe someone can answer that for me. However it's handled, whether it's in that same account or you have to transfer it out into another account, you're paying 15% on any amount above 1.6. That's fundamentally the principle. Barry says, "Hi, Alan. I sent you a link earlier today regarding bricks.com. This is regarding a purchase of a brick being a portion of a property that this company has bought. Are you able to interview an independent property expert that may provide an insight as to value and liquidity? Not sure if something similar exists internationally to acquire property." I'm not sure either. I did see that, Barry. Thanks for that, sending that. And I will be looking into it. As you may know or may not know, I've invested in something similar personally, which is Domicom, which is a listed company. I came in before that listed because I know the bloke who started it, Arthur Naomides, who started a business called Premium. And the bricks, as it's called, and Domicom are two different ways to fractionalise property investing. Bricks is kind of quite jazzy and interesting, the ability to buy a brick or a number of bricks. As to what its liquidity might be, I don't know. Domicom has set up a unit trust structure so that a unit trust buys the house or the property, whatever it might be, and there's a secondary market in the units in the trust. So there is liquidity. Much to my chagrin, Domicom is taking a while to get traction. It's true. It actually listed at 50 cents a few months ago and is now 12. So it hasn't been a fabulous success so far. So that's taking a little bit of time. I'm not quite sure how Bricks is going, but thanks for the suggestion, Barry. We'll check it out and see if we can interview them. I'm sure they'd love to come on and talk about it, as would Arthur. So I might get them both on, Arthur talking about Domicom and the people running Bricks. Matthew says, "Hi Alan, what do you think of the offer by private equity on Vocus? Do you think that the company will be broken up? Also, would you subscribe to Tom Elliott's view of investing at times of takeover attempts?" Tom has had a lot of success over the years, over a long time, by investing in a company as soon as a bid is announced. Some of the time, that bid is the final one. That's the last one they get. Most of the time, that is to say, more than 50% of the time, that first bid is the beginning of a process that ends up with a higher offer succeeding after a while, either because there's an auction or because the board persuades the first bidder to increase their offer in return for the board recommendation. And so Tom's view about doing that, and the reason for doing it is, firstly, if you buy shares after the first offer, your downside's protected because you know that the thing's going to be taken over and you're going to be taken out, even if you're taken out at the same price as you bought at least you're not going to lose money. And your chances of getting significantly more are pretty good. So yes, I definitely subscribe to Tom's process. I think he's done well over the years. As for Vocus, to be honest, I don't know what KKR are going to do, or whether there's an auction for it. A lot of people are saying, all the reporting I've read of the Vocus offer has been to the effect that KKR has opened the bidding. So I think there's generally an expectation that there'll be more offers for Vocus, and so yeah, I mean, I think it's probably an interesting proposition, no doubt about it. Jeremy says, I'm a young investor and saw last week you suggested dollar cost averaging investing in listed investment companies like Bailador as the best option for someone like me. So I was wondering how often I should invest and what the minimum investment should be, and also how should I keep brokerage fees to a minimum, seeing as I'm investing often. There's another question, but yeah, those are really good questions, Jeremy, and I think this is the question of brokerage. So firstly, how often should you invest? I think monthly is good, but that gets to the brokerage question, which I'll get to in a moment, and the minimum should be whatever you can afford. So it's a matter of choosing a savings amount that you can put away each month or quarter or whatever it is, and sticking to that, whatever the amount is. The whole principle of dollar cost averaging, for those who can't remember or don't know, is that you put the same amount each period, whatever the period might be, the same amount into a security, and as it goes up in price you buy fewer of them, and as it goes down in price you buy more of them, because you're putting the same amount of money in, and the result is that you tend to do really well, because when things go up, they tend to often get too expensive and you should buy less of them, and so you do. If they go down, then you buy more of them at a cheaper price. So look, so it's generally regarded as one of the best things to do over the long term. The reason I'm talking about it being a listed company is best is because they do tend to fluctuate in price, and you do get bargains sometimes with listed things, whereas unlisted things tend to be more stable. But the question of brokerage is very important, because if you're, say, investing, say you said, okay, well, I'm going to invest $100 a month, which is all I can afford, it's still worth doing. But the trouble is that the brokerage on that is $20 if you're with CommSec or ANZ share trading, and so that's 20% of the money each month going in brokerage, and that's no good at all. So it needs to be thought about, and so therefore the thing to do would be to not invest every month. If that was the case, if you only had $100, you should save it up for say every 3 months or every 6 months, probably better, so that you then made larger transactions, and didn't and so it wasn't as large a percentage going out in brokerage. So the brokerage, as I understand it, so CommSec and ANZ are both $20 or $19.95. Bell Direct is $15, and NAB Trade I think is $15, and the cheapest in the market at the moment, as I understand it, is a news service launched by a business called Self Wealth, and they've got a brokerage fee of $9.50. So I think that's the cheapest, $9.50, no matter what the size of your trade is. And really, we're talking about a commodity service here. I mean, buying shares, doesn't matter who does it for you, particularly if you know what you're buying. I mean, obviously some of these brokers in particular ComSec, but also ANZ and NabTrade do have a fair bit of research and stuff that you can get as well. So if you're interested in research, it might be worth paying a bit more. Self-Wealth have some kind of research. What they do is they map other people's portfolios, and so you can follow other people and what they're investing in, but they don't have sort of original research. But as I say, the $9.50 is the cheapest. Yeah, so look, if you're investing $1,000 a month, obviously the brokerage is far less, and it's less of a problem. The other thing is that if you're, because I always think you shouldn't be putting all your eggs in one basket. So if you were, for example, investing $500 per month, say, into 5 different securities, then each of those transactions, each of those purchases would get hit with a $20 brokerage, which again is 20%. You'd end up paying $100 in brokerage out of the 500. So that's no good at all. In that situation, you really should be saving it up and doing it every 6 months or something, or maybe even every year. The problem with that, of course, is you're getting less movement in the price of the security, but that's okay. I mean, I think the size of the brokerage in that situation is such that you really should be doing it less often than, say, once a month. Jeremy's got a PS. I didn't include this in the original question because it was getting fairly long already, but I was wondering if I should stick to just one LIC or invest in others at the same time, such as from ones investing overseas. Well, yeah, I do think that's what I'm saying. I do think you're better off having a few LICs to get some spread. But the problem with that is each one you buy is going to be extra brokerage, and if you're paying $15 or $20, it's really going to add up. So I think that probably the best thing is to put it in the bank, save it up for 6 months or 12 months, and then buy a number of, say, 4 or 5 different LICs, and try to keep the brokerage percentage to a minimum. Graham asks, why are main pharma shares going down so much when the company's going so well? Don't know. I'll have to get back to you on that, Graham, and I will. We'll see if we can add Mr. Main Farmer or Ms. Main Farmer to our list of interviewees. Good idea. Alan, another fascinating week. Thank you for keeping us abreast of happenings in a language we can understand. One could say it's been a 5-star Cov Fifi of a week. Yes, certainly has. It's been a big week, actually, and there's more to come. There's the James Comey testimony. We've already seen his opening statement to the Senate Intelligence Committee, in which he said that Mr. Trump demanded his loyalty. And I think tonight we've got the UK election. Next week we've got the Federal Reserve's decision on interest rates, probably going to increase rates next Tuesday, I think, or Wednesday. So yeah, look, plenty happening. Given the decisions, says Alan, and actions that have been taking place, might it be possible to task several of your best and brightest to turn their minds to what this might mean over the next 6 months or so, using one or more questions as a common baseline? Good idea. I mean, we, as you know, put out questions to fund managers who are terrific in their answers on the whole, and we had some great answers, you might have noticed, last week to the question, was actually the week before, but the question of what's the best way to value a company. They were really terrific. This week's question has been what's your golden rule? But I think you're right, Alan. We'll talk to them and ask the best and brightest about what all these events might mean. David says, Alan, the Kook is saying the RBA needs to lower interest rates ASAP. Do you agree? No, I don't, actually. I don't think they need to do that. I don't think they need to raise them. I think they need to just keep them where they are for quite a long time. There's no inflation. I don't think the economy is in danger of going into recession. It's obviously quite weak. The problem, and the reason I don't agree with the kook is that I don't think lowering interest rates will make a difference now. It just won't make a difference. What's needed is wages to go up, and that won't be achieved by putting interest rates down. Tim writes, "Hi Alan, what's your opinion on space exploration? With the likes of SpaceX and Amazon using reusable equipment, the costs of launches will reduce specifically. This seems a growth sector, and besides from investing in Amazon, are there any Australian companies with similar aspirations that could compete or be consumed by a merger and acquisition?" Not that I'm aware of. There used to be, what was the name of that? Oh, Navsat. That's right, there used to be Navsat, which went broke. Adrian Ballantyne's company. That was a satellite business. They weren't exactly looking at space tourism, but they bought, they tentatively bought some spots on rocket launches. So I'm not aware of any Australian companies that are engaged in that, but I'll have a look. I agree, it's very interesting. It seems to me terribly speculative, but maybe I'm wrong. I mean, Elon Musk and Jeff Bezos of Tesla and Amazon are pretty smart guys. I mean, Elon Musk is behind SpaceX, so if they reckon it's going to go well, then maybe that's maybe they're right. I don't know, but it's certainly very interesting, and it's worth having a look at. That's for sure. I think we'll have to leave it there. That's it for the questions. Thanks very much for your attending today. It's great. Remember, the live stream was general advice, may not be appropriate for you. As I mentioned, for next week we've got Chris Richardson talking about Linear's technology. We've got Hugh Robertson talking about his top stock picks, which are Bellamy's Afterpay and Sea Farm. The Sea Farm's the prawn farm prospect, which he reckons is going to turn into the Woodside of prawns. And Afterpay is the lay-by company, and Bellamy's is the beaten up organic baby food, baby formula company that is trying to sell it into China. So they're all quite interesting. We are going to take Queen's birthday off on Monday, but we will still send your stuff to you on Monday. All that usually comes to you on Monday will still come. So our email system will not have the day off. Thanks for your company. It's been great. I'll see you in your inbox with my overview on Saturday morning. Thanks a lot.